Let's get started. I want to say good morning, everyone, and welcome to Business Unusual, our weekly webinar where we talk about this unusual economy and predicament the businesses on Long Island have found themselves in. I'm Joe Campolo, and along with Peter Klein, we want to welcome Kevin O'Connor, the President and CEO of BNB Bank, with us today. We're on day 66 of stay-home order, New York, week 10. And the big news certainly dominating New York is that we start phase one reopening tomorrow, which allows construction and manufacturing and curbside delivery of retail to begin. So it's the start of something landscapers and gardeners are able to do. And one of my favorites, drive-in movie theaters are now permissible. And I saw Jaws 1979 in a drive-in movie theater. I think that's the last time I was at one of those. Anxiously anticipating phase two, so we're going to have to wait 2 more weeks, which will bring us to June 10th for phase two. And then what we're really all waiting for this summer is phase three, right? Which is the restaurants and food services to be open, and hopefully if things stay on track, we'll be looking at that perhaps for July 4th weekend. What we want to discuss is sort of big picture, where things are, where things are today, and then and kick that around a little bit, and then bring it down to Long Island and the businesses and the economy here on Long Island. Big news for today, Peter, has to be the stock market, and I'll preface it by saying this is why we call it business unusual. Consumer confidence is down. Unemployment is almost at 40 million or 20%. We're seeing business failures this past week with Pier 1 and Hertz. And yet the market is up big time today, having a great rally. What's that?
About 2.5% at 600 points. And yeah, it is unusual, isn't it? It's a little different. And I think for our listeners and our subscribers who are watching this, the message I would have is liquidity begets higher prices. When you have more and more stimulus dollars pumping into an economy and there's no other place to go but equities, although high yield bonds have also rallied pretty substantially too, risk assets are the place to go, and that's where all of this liquidity is gone. The question, of course, is it sustainable? Markets will go like a pendulum. They'll go from overvalued to undervalued. And on March 23rd, we were down 43%. Arguably, that pendulum had swung to the point of over concern and over worry, and perhaps too much so. And I think today we're seeing the opposite side of that pendulum, where things may be too optimistic. Because even if we get through, and let's hope we do, the next few weeks and months with COVID, the damage to the economy, the damage to behaviors, the damage to consumer confidence and consumer behaviors is, I think, the issue that we need to contend ourselves with.
Yeah, so we're at approximately 25,000 on the Dow today, Peter. Do we hit 20,000 first, or do we hit 30,000 first? What is your take there?
Let me get a coin out and toss it.
A nice easy question to lead with.
It's hard to say.
It's what's on everybody's mind, right? It's what's on everybody's mind. So we got to say something, Kevin. So it looks like. Go ahead.
I'll take it this way, though, as an answer, not to be glib, but our function as wealth advisors is not to be able to make our clients the most money. It is to provide them with a safety net, to provide them with a plan to make sure that they compound their assets over time. When we're in these unusual times, we're not casino players. We're not going to risk our clients' capital, their hard-earned nest eggs, to go in there to be the hot dot. Our job is to balance risk and return, and over time compound assets, and that's what we do.
Yep.
You did a very nice
job.
True,
politically correct answer. Really politically correct answer, Peter. Appreciate that. So, Kevin, it looks like I'm looking at some Wall Street Journal articles. It looks like we bottomed out, right? So, good news is it looks like for at least now we bottomed out. Numbers are starting to come back, and I was looking at this great article on consumer spending. I mean, things are starting to come back, but they're still way, way far behind from where they were, right? And so I think a lot of it is stimulus dollars have helped people come together, and PPP dollars, and you know all too well the attraction and the frenzy that happened with PPP. But is it good news? Is it bad news? The type of bottoming out and recovery that we're seeing. I guess recovery in any way is good, but how are you viewing where we are right now?
It's certainly, I think it's all dependent on the path we take, right? I mean, so I think that we talked earlier, this weekend seemed to be very busy. People are out, there's pent up demand there. And so you can definitely see that people are looking to spend some of their dollars, and they may start to feel while they are unemployed, maybe it does come back, maybe they get their jobs back, as things open up. I think that the big fear, and I think it answers the question, the previous question is, do we have any kind of in the fall, does this come back? And that would scare everybody.
Yeah, because consumer confidence is what it's all about. And I was looking, because one of the things driving the market today, Peter, is that consumer confidence actually beat what they predicted it was going to be. Now, the metric in early March, late February was 150%. We're at 86% now in terms of consumer confidence, but that's higher than what they predicted, and that to some extent could be fueling the market. But talk about consumer confidence and how important it is. I'm looking at the way we're spending money: travel, shopping, transportation, entertainment, health and beauty, all down. Is that a confidence issue, do you think, or is that just the fact that it's been shut down?
Well, I think it's a combination of both. I mean, clearly being shut down is obviously makes it difficult to spend dollars in those sectors. Many of us have conferences to go to, trips, graduation ceremony, all canceled, and those things are unlikely to come back, at least in the short term. I would say that the consumer confidence is remember, this is a big nation, and we have parts of our nation we're in New York, so we're in the center of all this. And maybe from that lens, we're seeing something different than perhaps somebody in middle of America or in different areas. So my guess is that the consumer confidence figures are very, sort of regional. I think we should look at them in a regional, sort of footprint. And I would suspect that, we need to be mindful that they do move around a little bit. So we need to be careful about that. And I think Kevin's spot on, that it all depends upon the track of the virus.
There are other parts of the country that are open. I mean, Florida seems to be open, Texas, and obviously there's some issues going on there. But they're sort of the experiment we're gonna play off of.
Right. The question, of course, is: would you go to a conference today? Would you hop on an airplane and go to California for a conference? Well, you might. You might say, I'll wear a mask, I'll wear gloves. Not a fun experience, but I'll go there. Maybe there are other folks that'll be there that I can interface with from a distance, try to do some business. I'm not sure. I'm not sure if we're there yet. Clearly, on the leisure side, I think it's a different ballgame. I don't think people are going to be traveling so quick to travel, especially with families. But we'll see.
Yeah, for me, it's not the travel. I would get on a plane in a heartbeat. It's just, why fly somewhere to do nothing? Right? Why fly somewhere to just do nothing? I mean, it doesn't make really any sense to me. Kevin, one of the things that came out today, and I want to talk about this from a lending perspective and where you see the credit markets going. So, here we are on the heels of 20% unemployment, 40 million people going to be unemployed, and the sales of new U.S. single-family homes increased to 623,000 last month, beating the estimates of 490,000. So from a lender's perspective, how do you do that, right? How do you let people buy new homes when there's so many of them are losing their jobs? Like, what's going on that doesn't make any sense to a layman like me?
It is somewhat confusing, but listen, interest rates are incredibly low. there are still a good number of people that are employed, right? I mean, one of the things that we're seeing here is there's lines at food pantries, but there's also lines for the $7 cup of coffee at Starbucks. So there are still lots of people employed, and maybe they're not traveling, not doing those things. And where they are spending their money, what they are doing is on their home. They're recognizing I may be home longer. I'm with my family. Maybe this isn't big enough for us all. And so they're taking advantage of low interest rates. I think, the banks are conservative in the way they're looking at income and things like that. So, I would say that it's obviously difficult if you're unemployed to have gotten that mortgage. But I think as an employed person, there's mortgage dollars out there to be spent.
Let me ask a
Is
question.
the bank? Go ahead.
Sorry, Joe. I wanted to ask a question about your team and the credit analysis work. So let's say, for example, you have Mr. Entrepreneur, your client that's banked with you for years. You've lent him capital. He's done well with it. He's built businesses. He's returned it. And it's been a good relationship. Now he comes knocking on your door and says, I see an opportunity here. I want to grow my business or what have you. He wants to perhaps buy a new business even. Are you more concerned now that it's post-COVID or in the end tail potentially of COVID? How do your folks look at that potential client and his need for a loan?
I think
That's a great question.
I think we're all looking at things much closer than we did before. I think you are asking the questions, what is the impact of this going to be on that business? In some cases, as you said, we've got some people that did take some of the liquidity because they're figuring out ways that, you hate to say, they may have opportunities because people are not as strong or as liquid in their industry and can take advantage of that and basically do some consolidation. You may get some people that if this was the last straw. Businesses get sold for lots of reasons, right? Family issues, and Joe knows this really very well. Family issues, financial issues. And so this is gonna accelerate some of those choices and decisions. And so we are still open for business. I think we're going to look at stuff a little closer than we ever did. But I think it's not a time for you to walk away from long-term clients and long-term businesses.
And that's really a question I get a lot, Kevin, right? And I don't want to put you on the spot because this applies across the line to all banks. But everybody's saying, hey, my line is I'm extended on my line. There are covenants in there about material changes to my business. Is it at risk at not being renewed? How are we going to handle that? So what do you think the industry, I'll leave it at the industry's approach from your perspective, needs to be on how to address these folks? Because that's the fear is PPP, everybody hurrah, hurrah, it's going to run out soon. But the long-term relationship with the banks is what's going to get us through this. So what do you suggest to people that they should be doing or start doing to help that?
Well, I think it's always been about communication. I think that, as you said, we were heavily involved in the PPP program. And at this point in time, we're sort of, I would say pivoting, but thinking about sort of the next level of this. So, we've created, I've got a group of people that, were on the credit side and the loan review side. I've matched them up with some of our lenders to really step back and looking at last year's financials, really meaningless at this point in time. It's having ongoing dialogue. What's going on in their business? How are they changing? How are they affected? What does their liquidity look like today? And this is going to be banker to customer in a lot of dialogue. I think generally speaking, a lot of that has to happen, right? This is a time where there should be more conversation, not less.
I think you guys fill an important void there because, correct me if I'm wrong, perhaps the larger, bigger banks would have a more difficult time being that banker to client kind of relationship. They're more numbers, they're more, there's a fit into our module or into our credit facility kind of thing. But it sounds to me like you and your team, Kevin, are doing more sort of one-on-ones, if you will, or Zooms or the like, where you really are sort of saying to your client, listen, we want to work with you. Let's discuss it. And I think that's an opportunity right there.
Well, listen, it's always been that way for the community banks. And even for the larger banks, it's just the level of talent. Certain businesses are sort of aligned in their branches. The branches may not have that sort of latitude and things like that. So it is incredibly important at all levels to have this kind of conversation. I was over the weekend, somebody was talking about, do you pay your rent or not, right? So consumers, are they paying their rent if they have an apartment? And it was like, should I or should I not? Well, if you have a job, you should pay it.
Yeah. And that's a great point, Kevin. That's another question I have, right? So the banks have to be looking at, right, backed up payables, whether people are staying current on their rents and everything else. And I get a lot of people wanting to try and find loopholes and shortcuts. And my feeling is, if you want to stay in business, you don't just have to be communicating with your bank. You got to be communicating with your landlord. You got to be communicating with your key vendors right now, and be working out a long-term plan to keep everybody alive. I think that's a really important point.
Well, I think especially if they want to get back, when we start opening, you're talking about phase 1, phase 2, phase 3, there's going to be liquidity, and your vendors are going to have to front some of your materials and things like that for you to get back in business, right? Think about the restaurants, the startup capital that they're going to need at this point in time. And so that's part of the dialogue. You're right. You need to be talking to vendors. You need to be talking to your employees. That's one of the things that in a lot of these conversations, the successful business owners and the entrepreneurs are the ones that the dialogue is even with their staff.
Yeah. So another question, Kevin. So I get a unique perspective insofar as I represent primarily Long Island businesses, right? And that's what I'm seeing. You guys have probably a much more broad base of Long Island businesses and other metropolitan area businesses. What are you seeing here on the island, though? Is it what is happening on the macro level where you just see a lot of pain, or do you see a lot of people, really being innovative and working to get themselves open and managing their cash flow correctly? How are you seeing it on the microcosm of Long Island?
Well, we're seeing some people that are being very aggressive trying to open. I think we saw some things this weekend. I think that generally speaking, the main streets are very sad. They're dark. The small little retailers are dark. The restaurants are dark. All the things that sort of were bringing Long Island back, the service industry has shut down. So the unfortunate part is that you've got the big boxes basically taking a lot of that revenue that the small businesses should get. And so the conversation is, how do we reopen, and how do these businesses, begin? And so you hope in sort of phase 2 and then we get to phase 3 that you see more of that happening. But it's the people that are sort of making sure that they are saving whatever liquidity they can, that they're having conversation, and they're figuring out how they reopen. Is it not going to be with the same staffing levels too? That's one of the things that even on our own side, we're starting to look and say, okay, our branches have, really branch traffic is down. Though I need as many people in our branches going forward.
Yeah, so I want to hear from both of you on this. So I read this morning that Bank of America has an extra $1 trillion in capital that people have not deployed. Either they took it out of the market, and there's all this liquidity that they expect to be pumped back into the markets. What are you seeing there, Kevin? Are people depositing more, holding on to more? What do you see from a cash flow perspective going on?
People are not paying people. I will say that. Our NSF fees, where you measure people that have overdrawn checking accounts, are down 60% month over month. So they're holding on to whatever liquidity they had. And so you are seeing that. And a lot of the PPP money that was taken, it's still sitting in their checking account. They're not spending it. This is sort of that emergency rainy day fund.
Yeah, I'm seeing that on my.
Yeah, and I think a lot of that is we're expecting Congress. Peter, hang on. I just think we are expecting Congress to extend out that June 30th date. I think that's probably a big reason too why people are holding on to that. Yep. Peter, from your client's perspective, are people investing more? Are they? How are they reacting from an investment perspective?
Well, I think folks want to. They want to be. It's one of these things where they want to be in the market, but in the same token, they don't want to lose. So it's the old difficulty of how to do that. We take a very balanced approach, as you know, to both risk and reward, and we feel as if there'll be opportunities to be had, during the course of the next year. And we're doing a lot of research, a lot of homework, really trying to pinpoint those drivers over the course of the next 6 to 12 months that are going to take us out of here. And I think that we're still very much avoiding the sectors that have been pummeled the hardest, feeling that they have asset impairment issues and potential impairment to their business models. So we are focusing on sectors and companies that are in certain areas that have sustainable cash flows, where they're not going to be as affected or impacted through COVID. And we feel those could be an opportunity if you could buy them at certain levels.
So
I did want to make a comment though about the prior question about Long Island itself, and I'm just jazzed to see how many companies have really pivoted and have made do as best they can, given the circumstances. So you see the restaurants that went into a delivery pickup, sort of situation with takeout only. You look at, sectors like even dentistry, which has been very hard hit, and how they're trying to just service, emergencies as best they can. That's an industry that's going to change dramatically because, the way of, you're not going to have waiting rooms anymore. People are not going to sit in waiting rooms. So they're going to have to stagger people coming in and out. It's a very delicate balance on how they're going to do that. A lot of businesses are going to change forever, I think, during this. And again, maybe for the better. We'll see.
Yeah, dental hygiene is going to take a hit. So here's something, Kevin, that I struggle with, right? So, as chair of the HIA, I constantly advocate for Long Island business. It's in my blood. I'm a full-blown cheerleader. But what I'm afraid of doing right now, is being overly optimistic. And the reason I'm afraid of it is I'm scared to death that people are going to spend whatever capital they have right now too soon, right? They're going to invest it in a recovery that's going to take longer than we think, and they're going to run out of capital. That's what I'm afraid of. So I'm trying to balance this optimism, which I believe we have. I believe Long Island is great entrepreneurs. We're going to recover. And I feel like I'm swimming against the tide sometimes because people want to focus on the positive news, right? And the positive news, while we're certainly seeing an increase, we're still way behind where we were in February and March, and we have a long road to hoe. How are you sort of balancing that as well? Because you're in the same spot. You need your clients to succeed, but you need them to be careful right now.
Yes, I think you do. You need to basically balance what they want to do and rush out to do, and say, let's step back a second here. Really think about it. Think about your business, because it will not be the same. I think your point about the dentistry industry, all of that will change. And so they need to really be thinking about if their business is viable, right? And, how will they adjust, and can they live with the less revenue that's coming in? And it is, it seems like it's a broken record, but it is a lot about conversations. It's the smart business people that we all do business with usually have some group of advisors, whether it be yourself, whether it be us, whether they're accountants, that are having those kind of conversations with them. And I always kid around I always ask entrepreneurs, who tells you no at times, right? Because Joe, you've met a bunch of them. When they say no, when they say there is nobody, that's what scares us all. So, yes, the Long Island business. Listen, I have hand sanitizer made by Long Island Vodka. So, and then we've got one of our customers that pivoted to make ventilators. And then we know there's lots of things going on in the park, on the medical side, what's happening. So this will take people tempering enthusiasm, as you said, but you do have to balance it out.
Yeah, it's such a fine balance. Go ahead, Peter.
If you look at the U.S. economy, about 70% of it is consumer, purchasing, consumer buying. So it's a big chunk of the GDP. And if that consumer, if the average American consumer is A, saving more, B, spending less, and C, spending differently, this is what we need to sort of look at. I mean, and there are takeaways from that, right? So maybe we don't travel as much as we used to because of the concerns with air, air in airplanes or hotels, but maybe we do more car travel, and maybe maybe camping will come back for young families. Who knows? But there will be some changes that come out of this. The idea is getting ahead of it, looking at where those opportunities are. I read something today about RVs and how RVs are becoming popular for that exact reason. Families, maybe young, maybe retired folk who want to travel but now are afraid to, will pop in their RV and they'll go see the country. And so, interesting. So there's always a pivot, and we have to sort of look where that puck is going and be there in time to make a change.
Yeah, I mean, we use the term pivot a lot, right? But here on Long Island in the 1950s, 1960s, there was not this restaurant entertainment industry. It was a manufacturing world, right? We completely shifted Long Island's economy, as we had to, from a post-Grumman world to now it's one of tourism and entertainment and restaurants. Okay, and now all of a sudden, out of nowhere, but that took time. That was a very gradual shift that occurred, and that took time. The challenge and the pain right now, I think that most Long Islanders are feeling. So there's always two levels of pain. There's government employees and school district employees, and they have their fears and their concerns. We get it. But they have pensions. Okay, they have pensions and they have health insurance. There's the business owner. Okay, and look, I'm one. We're all in on our business. Our pension is our business, and the ability, to make money and to have something one day to sell and equity to sell. And if that becomes decimated, we're in a much different position here on Long Island than we were as we grew through the Grumman era, because now all of these business owners just don't have that. And I think you're right, Kevin. I think we're going to see a massive M&A surge once this thing straightens itself out, because people are they're tired. They're tired and they're scared to death. They're watching millions of dollars evaporate. And so we are talking about it. But one thing that I have to say is we got to start having an honest conversation in how are we handling that, right? From an economic perspective, because curbside pickup at retail is nonsense. Who's gonna do that, right? Who's gonna do that when Amazon will drop something off the next day at your house? So I love the optimism. I do. The question is, can we pivot fast enough, right, to save those businesses? And that's what I'm very nervous about right now. Is we will eventually. But are we going to do it in a way that these businesses are sustainable, or is there going to be a vast graveyard of businesses, and then one day we'll see sprouts coming up years down the road? I just don't know, and I think that's what everybody's scared to death of. I think in the back of everybody's mind, they're deathly afraid that it's going to be the death of a lot of businesses, and then somewhere down the road we'll see entrepreneurs sort of spring out of this, some sprouts. But let's hope we can do something quicker. Kevin, let's turn to commercial real estate, right? So commercial real estate, a huge part of Long Island's economy. I'm sure a huge part of your portfolio. Where do you see that going over the next 12 months?
I don't see it going up. I think about between 10 and 15% of our loan portfolios are in deferral today. Basically, people are not paying. And so now they're not paying us. Are they getting paid some level of rent? So that's going to be the conversation that we're going through now. We're getting rent rolls. We're looking at it. I do think it'll be interesting to see, again, sort of what evolves, in our ground zero here, right? Because the things that, New York City may be a lot longer to open up than Long Island from the standpoint of the office complex. And so I don't know if this work from home thing is really long-term. People are going to, you may see a pickup in Long Island office space, right? People are going to be moving more satellite offices out here. But I do think again, it's going to be dependent on how these next couple months go. How quickly do we get back to some sense of normalcy? And so that people can pay their rents, and that will make real estate valuable. I mean, one of the things that we always think about out here, Joe, is that for a lot of entrepreneurs, their pension is not just their business. Most of them invest in commercial real estate as part of their sort of retirement plans. So we'll see how that plays out.
Yeah, it's a great point. You know, I hadn't thought of it, but it's a great point. I've been thinking about the Long Island Railroad and how the MTA is going to withstand it, right? I mean, that's a whole nother discussion that we're going to do on another series of this in terms of transportation. But it is a great point that, you know, Long Island commercial real estate office space really might find a boom with New York City companies that have to house their Long Island employees because they're just not going to commute on the train. And let's hope so. It's, you know, it's ironic for us here in our Ronkonkoma office. We just took additional space. We just got the furniture delivery the week before the lockdown happened, and I don't know if I get more frustrated just sitting home in my office or walking around here in the ghost town of an office that I have. It's really kind of an interesting time. And
let's flesh that out a little bit. So we could agree that everyone is fairly functional from a work remote environment. I mean, right? I mean, it's fairly functional. We hope it.
Yeah, but we hate it.
We hate it, but I worry that once things move forward and we get to, you know, an opening, that tenants might say to their landlord, you know what, I don't need that much space. This person and that person, they love working from home. They were very good at it, and I'll take half as much space. And so that's where I get a little. Even Long Island would be in that zone. Everything would be, and of course New York. I am being told that New York is not going to open until January. That major companies have told their employees, "See you in January in the office." That's going to be crushing to all the small businesses in Manhattan, and that's a concern. And again, the MTA, big issue.
And I think I don't fear a lot. I'm not sure I'd get on a subway or a Long Island Railroad train at this point in time. And I think I had January. I heard September, January. I think they're bouncing around. On the elevator part of the New York City buildings is what scares everybody. Is the Disney-sized lines to get onto the elevator because we're going to do 2 at a time, you know, which doesn't exist out here. So, he said we're fairly working from home. It's okay, but I don't know, Joe. New ideas are very challenging to come up with. The kind of ad hoc conversations that we all know our businesses thrive on don't occur. And then sort of the development of the younger people in our organizations is also not occurring in this method of working. So, and then, so if we do come back, you know, I have 4 floors here, and one of the floors we built and it's kind of tight, right? And I look at that because we try to get as many people as we could in this facility that we have. And at some point in time, that structure just may not work anymore. You know, I mean, so we may have less people in the office, but we're going to need more square feet for all the people we do have. So.
Right. And the underlying question, honestly, is it all bullshit, right? Are we just super overreacting to something that, and that is a vibe out there that I hear from a lot of people, and it's a lot of frustration. We just don't know, right? We're going to have to see if this thing surges again. We're going to have to see ultimately what the hell the real story is. And that's kind of what we're trying to figure out on these webinars. Let's shift for a minute to not-for-profits, okay? Because I think all of us, the 3 of us especially, have been heavily invested in not-for-profits here on Long Island and elsewhere, and charitable givings. And we're going to talk about not-for-profits in depth. But you know, for me, and I'm just being candid, right? For me, it's very hard. It's very hard to justify making major spends right now for not-for-profits when you're trying to hold your business together, when you're trying to make sure your people are able to have jobs and are able to, you know, to put food on their table. And so it's a rough time. It's a rough time. And of course, just the same way we took a lot more space before this hit is the same way we formally launched our own charitable foundation, CMM Cares, which we had great expectations for. But, you know, I think that people have to be very honest and candid. The same thing with communication with your bank and your landlord, with the not-for-profits that they've supported over the years, because they're hurting right now, right? And so what are your guys' feelings about that?
Well, I'll start
Peter?
off. Yeah, I'll start off. So yeah, I agree. I worry about the non-for-profit sector on Long Island. I think there's a lot of pain to be had. And I'm bifurcating that by looking at those nonprofits that are focused on food insecurity and healthcare. Those, I think, are the ones with the most emergent needs, and they're getting a large share of the charitable dollars from wherever it might be coming from, foundations like the one I'm involved with, or Long Island Community Foundation, or others. And then you have the non-food insecurity, non-healthcare, museums, art, dance, etc., all wonderful organizations. They're going to have a difficult time of it because there's just not enough capital to go around. And the capital that is going is going to be focused, I think, in those two areas.
I agree with you. I think that, and I think it's going to take the people who can afford to do it. I mean, I think that, you know, we're blessed. We did those PPP loans, which gave us, we're going to get fees out of that. And so for us, this is our chance to actually make a contribution. And so, but we will be focused on the organizations that you had mentioned. And so, yes, lots of those things that that usually get funded will not this year. It'd be interesting to see how the charitable giving, obviously our branch network started on the east end of the island, where every charity comes out for some of their summer money that they get from all the different events, and how that all works out. So
It's hard. It's going to be a hard year without the Hampton Classic too. We've all really enjoyed the Hampton Classic. So last topic that I want to talk about. So Secretary Mnuchin and Fed Chairman Jay Powell last week sort of testified before the Senate, and they have divergent views, right, on whether more stimulus dollars are needed, what sort of bailouts the states need. And this ties into the not-for-profits too, because a lot of the not-for-profits here on Long Island are state funded. Certainly the school district, everything, municipalities. Kevin, you know, your thoughts, stimulus, no stimulus, what's the right way for us, especially on Long Island, to plow through these next 6 to 9 months? Is it more stimulus, which is going to cause a tax burden and a deficit that we just can't get past long term? Or do we just have to sort of cut back and muscle through this? How do you see it playing?
there has to be some level of aid given to state and local governments. You know, the sales tax revenue that we live on Long Island from both of the counties is obviously down. And so there's got to be something there, but it does need to come with some level of cost. There has to be, as you mentioned, pensionary, there has to be some sort of give and take here. And it'll be interesting to see how this plays out in Washington. But to turn your back on the states where the hardest hit for us would be catastrophic.
Yeah, I can't see just things like the MTA surviving. I can't see any of that surviving without stimulus dollars coming out of Washington. But unfortunately, it's an election year, and it seems like politics gets involved in everything nowadays. Peter, your thoughts?
So mine are more on the global debt level. I'm doing a piece right now for Align Wealth that I'm working on the debt level, $26 trillion, 112% of GDP, maybe more. This is an issue that we have been ignoring for too long. And of course, the stimulus dollars was needed, and it helped, and it hopefully is flowing to the right places. We don't know that yet, but I think we're seeing some evidence of that. And I'm not saying we don't need it. We certainly do need it, but it has to be targeted. It must be targeted, because this notion of just adding on debt to certain levels, I mean, it's getting to be scary. Now, I know rates are low, so the servicing of that debt is not hard. All you need is a little bit of interest rate movement. I mean, not now, but once we move forward from COVID, and it's a lot of debt to have to service. So I do worry about that. I think it's an issue that investors have not put enough attention to.
Yeah, again, we call it business unusual because nothing seems to make sense. Never before in the history would we expect there to be a report that we're going to be at 20% unemployment and have the market up 600 points. It's crazy. And I got to tell you, I think the only thing holding American businesses and business owners together is the fact that the market's doing well. I think if the market was in the toilet right now, it would be a much different story out there. So let's hope that this rally somewhat continues. Kevin, want to thank you for joining us. Final thoughts, Kevin. What are your final thoughts out there for our business folks that are hoping there's some good news on the horizon?
Listen, I think just like you, Joe, I want to be optimistic. I want to think that the entrepreneurs that created the change in the Long Island economy continue to do that, continue to evolve, take this opportunity to sort of think about their business, to think what it will look like long term. And again, and I think this is an important part too. I think we need to have this conversation between government and business too, to evolve. Some of the things that you're hearing for the restaurants and the service industry as it gets back online, a more benign regulatory environment where the local governments are actually working better with the small business owners to help them.
Yeah, I think, ironically, I think Assemblyman Mike Fitzpatrick and his pension reform is going to find a whole new vibrancy when this is all said and done. Peter, final thoughts before we break for today?
Well, I think my thoughts would be focused on the investing public, and I would say to them, this is a stimulus-induced rally, and with that can come some unwinding, and with that some pain. So please let us be judicious in the allocation of our capital. That's capital that we might need in the nearer term, and let's make sure we are balancers. We've got to balance, else we could find ourselves imbalanced.
Yep, and my final thought is we got to stay patient. Look, I'm the biggest cheerleader out there, but we got to stay patient. We got to hold on to our capital as much as we possibly can right now till we see how this thing's going to break. So great discussion, guys. Really appreciate everybody's time for this week's Business Unusual. Every Tuesday at 11:30, we'll be talking about what things look like on the national economy and how that is going to impact Long Island and Long Island businesses. We'll be looking at different sectors. I want to thank Kevin O'Connor, President and CEO of BNB Bank, for joining us today. It was a great discussion, and we appreciate everybody's time. So until next week, everybody, just stay smart and stay safe. And we'll see you guys next week. Thanks, guys.
Bye now.